reached another important milestone for the Singularity Fund in January. Assets in the fund crossed the 50 million mark, and our firm assets under advisory are now around 65 million. In terms of performance, the fund was up by nearly 1%, outperforming the MSCI All Country World Index by almost 1.5%. Since inception, over a bit more than 3 years now, the strategy is up by 68% net of fees, more than double the performance of the MSCI All Country World, which is up by about 33% over this period. A big part of the returns in January came from our China allocation. Names like Tencent, Meituan, NIO, and Alibaba were top contributors. Other strong contributors outside China were Tesla, Thermo Fisher, and Microsoft. One of the main takeaways is that the combination of different singularity sectors is key because of technological convergence. I would like to highlight 3 interesting areas from my perspective. Social polarization, public distrust, and the so-called cancel culture will further propel the trend towards technological decentralization with new upcoming platforms and social networks and further spreading blockchain use cases. The COVID-19 crisis has supercharged the e-commerce trend, and captive ecosystems that combine commerce, finance, data, and marketing will drive strong value creation. The proliferation of health data will lead to improved prevention and patient care going forward. And AI, blockchain, and the Internet of Things will enable all of this as part of a seismic shift. So I think by now, most people have read a lot about the situation, and we could spend hours talking about the merits and dangers of short selling or the current anti-establishment movements and sentiment and other things. But basically what happened is that literally an army of retail traders used a big message board on Reddit called Wall Street Bets to engineer a short squeeze on GameStop, which is a small and heavily shorted retailer in decline. This really spiraled into a short squeeze in some other downtrodden names like AMC Cinemas, and even led to one fund that was short called Melvin Capital needing a bailout. It also led to some contagion in the equity market as those short sellers had to deleverage their portfolios, which also pushed down prices of high quality stocks and the market in general. So long story short, due to the explosion in price and volume for this GameStop stock and other hot stocks, Robinhood and other brokers had to put up deposits with the clearinghouse, which were about 10 times larger than usual because of the increased risk profile, and it didn't have the money. So they restricted trading and had to raise money from existing shareholders. Actually, the founder of Interactive Brokers said that on Thursday evening, there was roughly 10 to 15 billion of losses on one side of the GameStop trade, mostly via options, with 10 to 15 billion of gains on the other side. And that is serious counterparty risk, which clearinghouses deal with by increasing deposit requirements. If anybody really profits from all of this, it's probably the market makers like Virtue or Citadel. Now, in the meantime, most of these stocks that have been on a momentum tear are crashing back down to earth as we speak. But what does all this mean in the long term? I don't think there's anything new about people spiking a certain market or the mechanics of short squeezes. But what is new is a short squeeze orchestrated by a few 100,000 retail investors, kind of like an online game or way of making a statement and trying to stick it to the establishment. And this does raise questions about systemic risk from retail attacks going forward. For the sake of stability of financial markets, if that is even a word, what you want is to prevent wider contagion that spreads into other markets. And I think these questions will have to be dealt with. However, that probably won't stop the democratization of financial markets and asset ownership, and shouldn't for that matter.